with those losses that we saw yesterday and also last week in the S&P 500, how much more of a drawdown would you need to see in US equities before thinking now's the time to buy the dip?
I mean, you had a very tough setup coming into this because for most of this year, markets were boosted by monetary policy without any growth. And that really concerned us. We were highlighting that if you just look at the Shiller PE in the US equity market and the level of growth you currently have, you had the highest drawdown risk since the financial crisis. So from that perspective, now that you have further growth shocks, essentially now leads to this drawdown. If you look at valuations, however, they haven't really reset that much because you've come such a long way and you haven't really seen growth pick up alongside that, no? So valuations have continued going up, being boosted by the search for yield. So we would think that you would need a bigger reset. And we always like to look at our risk appetite indicator, which just aggregates valuations across assets. And historically, that always gave us a good signal when you drop to -2. Just to give you a sense, we're currently at -1, roughly. And we dropped only kind of 0.2 in the last week. So it's kind of theoretically, before we really can talk about valuations being a support, it's still some time. So the drawdown could continue.
It could certainly continue. Christian, good morning to you. What we've done is we've tried to translate some of that sentiment into a couple of charts. One is the S&P 500, but it's also the RSI. And the RSI, by the way, globally, stocks had their biggest movement yesterday since February 2018. Where are we in the trade war angst? What do you make of what the Chinese did yesterday and this morning?
Yeah, as I said, the big problem has been throughout the year, people were really struggling to see a positive growth story. I think you had the global manufacturing moving into recession. I think the services sector held up nicely, but people perceived that to be lagging. So you had a real lack of growth. And the trade war is partially responsible for that and certainly exacerbates the growth angst. And as a result of that, it is a key sentiment driver. And we've said that and we've seen that throughout the year. So now the trade war is escalating, and I think this is why yesterday was such a big deal. It's going into FX arena. Like you were starting to see kind of China respond via the currency. It's being labeled a currency manipulator, and there's already been a lot of concern about competitive devaluation. The reason why that matters is it's essentially a world where you're already fighting deflation in a lot of places in the world. So if you are falling behind in that competitive devaluation race, you have the risk of importing deflation and further exacerbating secular stagnation problems. And that's the key issue you're facing. Investors have already struggled to get excited about growth, and now you're entering that deflationary kind of threat on top. And I think that's why weighing on investor sentiment. I think what plays a role with regards to deflation as well is the looming prospect of a profit recession. Because after 1.5 years of global growth deceleration, we only now are starting to see profits suffer to an extent where 12-month forward EPS is starting to turn negative. So far in the search for yield, people were happy to some extent with lower bond yields boosting equities because the dividend yield was higher and you had some opportunities for carry. But now people are questioning the dividend.
Yeah. What is all this going to mean for volatility? I mean, the VIX got to almost 25 yesterday, and volatility, at least if you look at the VIX as the measure, higher than the 2019 average at the moment. But is this actually the start of a higher vol regime?
I think there's a real concern here, which is throughout the year, growth has decelerated, and weak growth normally means more volatility. Yeah. You can see that very nicely. So if you have global growth below 3%, if you have US growth below 2%, historically you have a higher VIX, you have more volatility. That's the most important driver. But you haven't really seen that this year. And the reason for that was the central banks stepped in and really stabilized volatility. But there has been a very subtle regime shift where in the recent repricing of the Fed, the yield curve has actually kind of not been flat, not stayed stable, but actually flattened further. So from here, the market is shifting from a template where Fed easing is good and stabilizing markets to a template where Fed easing is increasingly perceived to be kind of indicating recession risk. And that essentially means that near term, the risk of volatility staying high is definitely there, up to the point where the market is willing to fade the recession risk again.